But let's just try to see if we can tease out a couple of other points from this broad range of interactive deals in late 2009 across a broad range of sectors as M&A resumed in earnest. And now in early 2010, I can tell you the market is very, very busy. A ton of conversations going on between large technology and diversified media and marketing companies and high growth, privately held or venture-backed interactive companies. So let's jump into what the deals are saying and what are they not saying. First of all, the largest transaction of last year, of course, was the sale of a majority interest in NBC. And that calls into question what's going on with brand advertising. Is brand advertising in decline? Click. So traditional brand ad vehicles have been hammered. If you look at the performance of a clutch of groups like Yahoo, New York Times, CBS, Gannett, Media General, badly underperforming the market as a whole. And we've seen a series of distressed sales of brand advertising properties. Obviously, the recession has something to do with it, but we think this is not just the economic cycle. It's Eric's fault. No, more on that later. It is actually spending continues a secular shift to promotional and interactive. During 2009, for the first time, consumer marketing spend on direct promotional digital marketing exceeded total ad spending in traditional measured media. And so those lines crossing between traditional brand media and growth sectors. And if you look over the next 4 years, and this is using figures from Verona Suler, there's going to be $41 billion of net new spending across these media. 99% of it are going to go to these growth sectors of promotional and interactive media. So clearly, the tide has gone out and you see who's ugly. Branding and execution are moving closer together, at least for some. If you look at one major online ad network, these are their top 10 clients in 2009. And I think you would all agree that there are some brands in that picture. On the other hand, it's all cyclical. And better and more efficient promotion will just bring the need for better product differentiation, also known as branding. So we are reminded a bit of Mark Twain's famous quote that reports of my death are greatly exaggerated. Brand advertising is not out, but it is changing dramatically. Well, one of the ways it's changing dramatically is with targeting online. This is a tectonic shift in the market that we all know so well. So display advertising demand traditionally has been sold, as we all know, site by site, focusing on the audience that's comped by a given site. And this is where publishers do their thing and do it well through consultative, creative, customized solutions. But there's a fast-growing sector that we heard about yesterday, David Moore predicting that it will continue to grow, and that's selling audience, where impressions are individually targeted by behavior, like in-market intent, context, geo, and demos. And just taking a rough look at the market growth, this is using figures from eMarketer, and by the way, we want to thank eMarketer for access to some fabulous information as we pull this together. But figures from eMarketer and some research from other firms, total display advertising online is expected to grow from $7.9 billion last year to $9.8 billion by 2011. We estimate that last year that was about 80% site sold and 20% audience sold. Just in terms of a rough estimate, and this is highly illustrative, that share is likely to grow to, say, 30% by 2011. And what does that mean? Audience is going to grow at 36%, and site-specific sales are going to grow at 4%, a fairly stagnant growth rate. Are these going to be the right numbers? No, of course not. But the picture is much faster growth for the next few years in audience. It's no news to everyone in this room that there are a ton of players getting into the audience selling market, a massive proliferation of new types of companies and companies, starting with the agency platforms, and we're going to hear more about those, demand-side platforms, many of whom are here today, and a number of folks jumping into that, a ton of new interesting data sources out there, a ton of ad exchanges and publisher-side platforms who offer real-time bidding. And finally, Starbucks. We've heard this morning that Starbucks is launching ad exchanges in all 20,000 of their outlets, as you can see there on the left. And a ton of money is flowing into this. Close to my heart, there have been a wave of major transactions and financings. We had the privilege of selling Acerno to Akamai, BlueKai and Quantcast, both very good data providers, have raised a fair amount of money. Plus, the DSPs as a group have raised over $140 million just of disclosed investment. There's quite a bit more into that. And these are happening at very healthy revenue multiples. And at the same time, a lot of investment in real-time bidding, which you need, of course, to target effectively, as most of the major players prepare for that, and biddable volume is beginning to scale. And so we see, and a lot of folks see, a coming land war for margin in the brand advertising delivery chain. This is a classic cannons and cutlasses 19th century European land war. On the left, you've got the ad delivery players, the CDNs, the display technology, the ad servers, the rich ad providers, the video networks and the ad networks, all of whom have businesses that when they're well managed, and those guys certainly are, deliver very good margins. Those are terrific businesses to own. On the right, you have these new ad targeting players coming into the picture, and they're gonna want their piece of the margin pie. And squeezed somewhere in the middle are the publishers, and to a lesser extent, the agencies as well. There is going to be a land war over how margin gets redivided in the audience world. So just giving, again, an illustrative view of what that might look like, and this is focused on the inventory that publishers choose to make available on an audience sale basis. Obviously, on a site-specific and premium sale basis, they're getting CPMs significantly above $5. But as we all know, in our more honest moments, no publisher is able to sell out anywhere close to 100% of their inventory. I used to run a publisher that's an IAB member, and there's just no way we would ever sell out. 50% was a pretty high watermark in terms of selling out our inventory. There's going to be a ton of inventory available. It's going to flow into the audience ecosystem, and that $5 CPM, 75 cents to the agency, a couple of bucks to the ad network, 75 cents to the data provider, 25 cents to the ad exchange, 25 cents for ad serving and rich media, and you're left with a buck for the publisher. Now, that buck is still better than a goose egg, but it's an interesting picture. I think you would all agree. So we have a couple of new participants in the middle, the data provider and the ad exchange, who are taking roughly a buck out, and some new pressures on the publishers, the agencies, and the ad networks. So let's take a look at how we think those folks are likely to respond. First, what about the ad networks? Well, first, M&A in the ad network world was really busy in 2007 and 2008. A ton of transactions as the logic of aggregating either the long tail or premium inventory took off, and a number of companies were sold. Likewise, a number of companies were bought by private equity groups, whether they were buying a majority or a substantial piece of the company. A lot of activity. Get to 2009, 2010, a bunch of mobile deals, but in the online world, not a lot. So what is this saying? Well, there's a clear divide between the old school and newer audience-driven ad nets. And I think in 2009, you had the recession. That didn't help. But you also had a lot of uncertainty over how this new audience world was going to evolve and who were going to be the winning players there.